We just finished going through Bloom Energy's 2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. Here's the number that stopped us cold eye one quarter over $1 billion in revenue from a company that took 21 years to reach its first billion. EPS came in at 78 cents when the street was looking for 40, but don't celebrate yet because a beat this big raises its own questions. So today we're pulling this thing apart, the power boxes, the margins, the money behind it, and where the real risk is hiding. The company stated Q2 revenue hit $1.065 billion, the first single quarter this company has ever put over $1 billion. Think about that pace, 21 years to reach the first billion in revenue, and the filing shows they're set to double it in a single year. Revenue grew 66% year over year, and EPS landed at 78 cents against a consensus of 40, nearly double what the market penciled in. Here's the thing, a lucky one-off can look like this too, so a single blow doesn't prove anything by itself. But the company also raised all three full-year guidance metrics at once, revenue, operating profit, and EPS, and called it structural acceleration, not a one-time spike. Our take: when a management team lifts three numbers together, they're telling you the demand isn't a sugar rush, it's a step change. I'm maybe 70% on that read, the guidance backs it, but guidance is a promise, not a receipt. The company describes the product as a solid oxide fuel cell, no burning involved. It converts fuel straight into electricity right on the client site. You drop the box next to the building, and it bypasses the traditional grid entirely. Picture the corner diner that finally stopped waiting on the utility and made its own power. The filing shows the money splits two ways: equipment sales about 90% of Q2 revenue, plus long-term maintenance contracts underneath it. Our read is that maintenance tail is the quiet hero here, because hardware sales are lumpy, but service revenue shows up every quarter like rent. The company frames the catalyst plainly: AI data centers are getting built way faster than the grid can expand, and that gap is Bloom's opening. To be fair, the bears would say 90% of revenue riding on equipment sales is a heavy load to carry if orders ever pause. So we're watching that service mix. A reasonable read is the more it grows, the more durable this whole model becomes. Here's the context the company puts up. A single 1 gigawatt AI data center can generate $12 to $24 billion in annual revenue. Now do the math on waiting. The legacy grid runs on a timeline of years, with connection backlogs stretching to 2029 and beyond. That means billions of dollars in AI chips sitting idle as stranded inventory instead of running as active compute. Bloom's pitch is a timeline of months instead, and the company states every single month saved in power connection generates $1 to $2 billion in extra revenue for the operator. Pay attention here, because that reframes the whole sale. The fuel cell isn't a cost, it's the thing that switches the money on sooner. Our take: if those numbers hold, the capex on Bloom's boxes is wildly accretive for the buyer, and that's a very easy check to sign. I'll Steelman the skeptic though. Those are the company's framing numbers, and a hungry customer will always say speed is worth almost anything. The company lays out a stunning adoption curve. Hospitals and factories took roughly 10 years to make on-site power a standard. AI data centers, the filing shows, replicated that same curve in under 9 months. That's the kind of compression you rarely see. One number jumps out: 55 days for Oracle to go from first contact to fully powered, start to finish. They also state 100% of major US hyperscalers have now validated and approved the technology, with 12 plus neo, clouds and colocation players in the pipeline. The company's own line is that this is not a faster horse, it's a car, and it's irreversible. Look, that's management talking their book, and I'd take the word irreversible with a pinch of salt. Nothing in tech is truly irreversible. But our honest read is 100% validation across the big hyperscalers is hard to wave away. That's a real checkable fact, not a slogan. This is the page that matters most, so slow down with me. Revenue grew 166%, while operating expenses grew just 48%. The company calls that the scissors effect, and the blade's opening is exactly what operating leverage looks like when R&D and overhead stay put while volume scales. On margins, the filing shows gross margin at 34.3%, up 604 basis points, and the services line swung from minus 21% at IPO to plus 22% today. A 43-point swing in services margin, yeah, not small. The company reads that as the business finally hitting technical maturity. Then there's the cash fortress. Operating cash flow of $226 million, up $439.5 million year over year, and $2.7 billion in total cash. Adjusted EBITDA came in at $253 million, about 24% of revenue. So this quarter actually threw off real money, not just a pretty income statement. Our take is that scissors gap is the single most important thing to watch. Hold it, and everything else works. Let's put the two beats side by side because the sheer size of them tells the story. On profit, actual EPS was 78 cents against an expected 40. The company frames that as a 95% outperformance, nearly double. On the top line, revenue came in at 1.065 billion versus an expected 815.6 million, a beat of almost 30%. Here's why crossing a billion in one quarter matters. It stops being just a percentage growth story and becomes a question of absolute scale. The company credits disciplined execution of the backlog and converting data center demand into realized revenue, not hype. To be fair, a 95% EPS beat also tells you the analysts modeling this were badly behind, so some of that gap is their miss, not just Bloom's magic. Our read, though, is that a near 30% revenue beat is much harder to fake than an EPS beat. You either shipped the boxes or you didn't. The company stacked 3 upgraded targets for full year 2026 and they lean on each other. Revenue scale first, a target of 3.9 to 4.2 billion, which the filing says is roughly 100% growth over 2025's baseline of a little over 2 billion. Then the profitability leap, 800 to 900 million in non-GAAP operating profit, with the midpoint margin jumping from 14% up to 21%. And the bottom line, EPS 255 to 2.85, built on defending gross margins at a strict 34% floor. The company says the stack rests on 2 layers. Algorithmic backlog conversion plus in-year new orders, amplified by that operating leverage. Here's my caution, and I'll grade it: doubling revenue while nearly doubling operating margin is a lot to promise at once, so I'm maybe 60% they hit the full range. Our take is the 34% gross margin floor is the number to hold them to. If that cracks, the EPS target goes with it. On capacity, the company leans on what it calls a copy-exactly manufacturing engine, scaling up from a 2 gigawatt baseline. They claim factory capex pays back in months, riding the same cost down curves you've seen in consumer electronics and semiconductors. Here's the part I actually like. The power units are fully modular, so if one client site gets delayed, they literally reroute the box on a truck to another site. Think of it like a rental car company. If one branch is quiet, you just drive the inventory to where the demand is. The company argues that modularity de-risks the whole guide because 2026 revenue doesn't hang on any single mega project. Our read is that's genuinely smart design. Standardized movable units mean a slipped order that doesn't blow a hole in the quarter. To be fair though, they slap a low risk label on it themselves, and no manufacturer scaling this fast is ever truly low risk. We suspect the ramp is tighter than the sticker admits. Money talks, so follow it. The company states clients mostly want to finance long-term power rather than buy the equipment outright. That means Bloom needs deep capital partners standing behind it, and this page shows who is actually showing up. On the syndicate side, their financing vehicle added Oaktree, MEFG, and Morgan Stanley for 2.6 billion in cumulative commitments, contributing real revenue in Q2. The bigger one is Brookfield. The filing shows the framework expanded in just 9 months from 5 years into a massive $25 billion commitment. Here's the tell, and I buy this one. Capital of that size doesn't chase press releases. It follows bankable orders and satisfied repeat clients. When a partner like Brookfield quintuples a commitment in 9 months, that's a sophisticated buyer voting with a very large checkbook. I'll flag the other side honestly. Heavy financing also means Bloom's growth is tied to partners staying willing, and that willingness can cool if rates or sentiment turn. Now let's separate the story from the math, because this page does exactly that. Claim 1, they're the definitive AI on site standard, and the reality check comes back verified. Oracle's 55-day speed and a greater than 90% product revenue share are hard evidence of dominance. Claim 2 is where it gets serious. Management says the structural operating leverage will sustain. The reality check calls this the critical valuation pivot, and I think that's exactly right. That and 66% revenue growth versus 48% expense growth scissors gap is the single most important variable to track, full stop. If that expense gap holds, the premium valuation holds, but if operating expenses start creeping up with volume, here's the danger. The stock carries a beta of 3.74, and the filing itself warns that beta will ruthlessly punish the valuation if the leverage story slips. Our take, this is the honest heart of the whole deck. The bull case and the bear case both live inside that one gap. The company breaks down its greater than 90% market share into 4 defending walls. 800-volt DC native output, zero overbuilding needed for reliability, clean enough emissions to sit legally in dense city centers, and rapid permitting with turnkey delivery. Those are real advantages, and together they explain why Bloom keeps winning the fast jobs. But, and give the company credit for putting this on the slide, they name the threat 2, turbines, reciprocating engines, and molten carbonate cells. The stated vulnerability is blunt. When the power deficit is this extreme, anything that powers up quickly gets a look, even a weaker technology. Here's the synthesis I want you to hold on to, and it's the company's own, that 90% share is built on speed and turnkey execution, not an absolute technological monopoly. Our RID, that's the crack in the armor. If the AI build-out ever slows, this rarity premium is the very first metric that gets tested. This is the risk page, and I appreciate that they actually put 5 red gauges up in daylight. 1. Lumpy revenue. Mega campus deliveries aren't smooth, so 1 or 2 giant clients can swing a single quarter hard. 2. The manufacturing ramp. Hyper scaling that copy exactly engine leaves basically zero margin for error in the physical supply chain. 3. And this one earns a real eyebrow. They withdrew former free cash flow guidance and swapped in a new $375 million plus operating cash flow baseline. Dropping a cash flow metric is a transparency alert, no way around it, and we'd want a very good reason for it next quarter. 4. Long-term substitution risk, defending share against gas turbines and alternative engines as the legacy grid slowly catches up. 5. That beta of 3.74. Nearly 4 times the market, which means the tiniest AI slowdown headline whipsaws this stock, and I've been burned by high beta darlings before, so I don't take that lightly. Here's a neat tell from the call itself. The company mapped which questions the analysts pushed hardest on. The highest heat, 4 times the inquiries, came on capacity execution from JP Morgan, Morgan Stanley, RBC, and Mizuho. Management stayed highly resolute there, insisting capacity won't be a constraint. But notice, they strategically withheld the exact gigawatt run rate numbers. That withholding is interesting. A reasonable read is they don't want to hand competitors the map, but it also leaves us guessing on the one thing the street cares about most. The next band of heat, from Baird, Bernstein, and Oppenheimer, leaned on the market share and turnkey value story, and management defended it confidently. And a third cluster pressed hard on that withdrawn free cash flow guidance, with the company pointing firmly back to the $375 million cash flow baseline. Our take: when the smartest banks spend most of their questions on capacity and cash disclosure, that's your signal for where the real doubt sits. Now the forward story, and it's the most interesting bet on the whole deck. The macro setup: the company points to 30 to 40 gigawatts of new AI capacity projected to come online by 2027. The twist is spatial. Training data centers can sit out in rural nowhere, but inference data centers have to be near the users, and you can't drop a noisy, polluting gas turbine into midtown Manhattan, so a clean, quiet fuel cell fits that urban gap perfectly. Then they invoke the Jevons paradox: as AI tokens get cheaper, usage explodes everywhere, and aggregate power consumption skyrockets. So the company argues it's riding a dual engine, a bigger total market plus growing share inside it. Here's the honest catch, and they say it themselves: the ultimate test arrives when the legacy grid finally catches up and peak AI capex normalizes. Our read: this is a beautiful growth story, but every one of those macro numbers is a projection, not a receipt, so hold it loosely. The company closes with a scoreboard, 6 KPIs to watch, and honestly it doubles as our watch list too. 1. Scissors gap integrity. Does revenue keep structurally outpacing operating expenses? That's the whole thesis in one line. 2. Gross margin defense. Can they hold that roughly 34% non-GAAP floor even when they have to rush physical deliveries? 3. The operating cash baseline. They need to strictly defend that new $375 million plus cash flow line to justify dropping FCF guidance. 4. Backlog velocity. Management claims backlog is growing faster than revenue, so any inversion there is the first real sign of demand cooling. 5. Client concentration. Watch whether that 80% repeat order rate from 2025 holds as the client list stays top heavy. 6. The scandium supply chain. Track that raw material constraint against the 25 gigawatt deployment pipeline they're pointing to. Alright, last thing, radar always leaves you a light. I'm calling Bloom Energy a yellow. The business is flat out impressive, the first $1 billion quarter, a real cash fortress, and dominant share in the fastest corner of the power market. But here's what holds me back: a beta of 3.74 and a premium that's already priced a lot of this in, all riding on one scissors gap staying open. If they hold that 34% margin floor and keep operating expenses lagging revenue for another quarter or two, I flip to green, and I'm telling you that up front. If the expense gap narrows though, that high beta cuts the other way fast, and I'd step aside. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.